Good morning and happy 4th, everybody. Today, I'd like to discuss with you the GameStop meme stock report. And there's a few things that I'm going to share with you. I did watch True Demon's video, which I highly suggest everybody takes a look at. I am going to analyze the key points of it because it is very long, and I know that you guys may not have time to read it, but to watch it, excuse me. But I'm also going to go over an article that I think sums it up nicely, my notes. And guys, this is extremely important that you guys are aware of this report. If you have the time to read the 138 plus pages or whatever it is on it, I highly recommend you do because it's extremely eye-opening. However, I'm going to analyze the key points of it, go over an article that I really like the way it was written, that discusses it, and then, like I said, give you the key points from True Demon's video. Guys, there is so much corruption in this market and it is very unregulated. And even the regulation that's in place, there's basically no follow through. And this report reveals that. And I want you to realize how important that is and why the market is having such insane issues. I mean, guys, it's out of control with the dark pool trading anywhere between 60 to 90% of all trades on tickers, guys. This is a corrupt market that is not made for retail to win. And in order to beat them at the game, you need to realize how the game is played. And hopefully I can open some eyes for you guys to understand this. I'm going to set this up in a format so that you can listen to this as a podcast. I will be showing a few key things, but again, I'm going to be reading it out to you so you can listen to this when you're in your car, when you're driving, at the gym, just doing yard work, whatever, because I really want you guys to listen to what's going on. It's very important that because knowledge is power, guys, and without that, then I'm sorry, but you're going to be set back because you don't have any clue why they're doing what they're doing and how they're getting away with it. So let's get into this. Nothing I say is financial advice. I appreciate you listening. If you could please like and subscribe, I'd appreciate that as well. Thanks, guys. I'm going to begin with the article titled U.S. Congressional Report on Meme Stock Reveals Robinhood's Culture of Growth Over Stability by Tim Fries. Robinhood's unique business model strained the market's capacity to accommodate retail orders, as per U.S. House Committee report. After 2 years of headlines hearing the class action lawsuits against Robinhood, the U.S. House Committee on Financial Services finally delivered its report last Friday. The title of the 138-page document is long and self-explanatory, dubbed GameStop: How the Meme Stock Market Event Exposed Troubling Business Practices, Inadequate Risk Management, and the Need for Legislative and Regulatory Reform. U.S. House Committee report takes in-depth look at meme stocks. Before delving deeper into the report, here is a brief recap of why GameStop, AMC Entertainment saga has been the focus of so much attention. Retail traders mobilized across social media to short squeeze Wall Street hedge funds, who were shorting GME, AMC, and other stocks suffering from the lockdown fallout. Their primary tool was the Robinhood brokerage app, known for pioneering zero-commission trading. It quickly becomes one of the most popular stock trading apps in the country. Furthermore, the company's motto has been democratize finance for all. The clash between retailers and hedge funds created unprecedented market volatility as GME value skyrocketed by 2,700% within the month of January 2021 alone. As a result of these conditions, over 2 million trade orders failed to execute. This caused several brokers to restrict trading in targeted meme stocks. One of them was Robinhood, which held $2.6 billion in GME shares and $1.3 billion in AMC shares prior to implementing trading restrictions. Some hedge funds engaged in shorting GME, AMC, were also indirectly tied to Robinhood's payment for order flow. The payment for order flow business model allowed Robinhood to offer zero commission trading in the first place by paying market makers such as Citadel Securities to route customer orders in exchange for a fee. Therefore, payment for order flow not only incentivizes zero commission brokers to intensify retail trading activity, thus creating market volatility, but it also creates a seeming conflict of interest. In fact, it was suggested that Robinhood intentionally sabotaged trading due to its payment for order flow obligations. Based on these events, the Committee on Financial Services had to figure out if the stock trading pipeline is robust enough for future use, and if not, to identify and plug the leaks. One of them was Robinhood, as the fastest growing stock trading platform handling the most trade orders. Report identifies key issues with super brokers like Robinhood. While Robinhood recently settled a class action lawsuit related to outrages in March 2020, the lawsuit pertaining to GME AMC short squeeze was dismissed by the federal court in Florida last November, although Chief Judge Cecilia Altonga noted somewhat suspicious electronic messages between Robinhood and Citadel Securities. This did not rise to the level of plausible conspiracy. Nonetheless, the House Committee report found faults in Robinhood's business model. Failed to incorporate best practices according to the Financial Industry Regulatory Authority, which is FINRA, guidelines regarding stress testing its platform. Failed to incorporate best practices according to the Depository Trust and Clearing Corporation, otherwise known as DTCC, regarding sufficient collateralization. In fact, without the DTCC's waiver for the deposit requirement, $9.7 billion in total on January 28, 2021, Robinhood would have defaulted on its collateral obligations. Apparently, DTCC prioritized market stability over strict adherence to regulatory rules. Guys, Robinhood was in a $9.7 billion margin call that they basically just waived and said, it's all right. No worries. You don't have to, put up that margin. This is so messed up and wrong. If you had a margin call for $100 or $200, they would liquidate your account. Robinhood had one for $9.7 billion. This is messed up, guys. Let me continue. Robinhood's over-reliance on the PFOF business model strained the capacity of market makers to keep up. Robinhood's public liquidity assurance prior to stock restrictions don't add up with its executive actions scrambling for emergency funding. Overall, the committee pointed to low barriers to market entry and gamification as primary culprits for market instability. So guys, again, they're going back to low barriers to market entry, meaning like you can basically trade with like $5, and gamification, like when Robinhood's app previously used to set off confetti when you bought stuff. So they're using that as an excuse, and I want you to pay close attention to this as I continue with what I'm going to be discussing today, because there's a problem here. So I'm going to repeat this again. Overall, the committee pointed to low barriers to market entry and gamification as primary culprits for market instability. Guys, they're not blaming the $9.7 billion margin call that they failed to enforce. They're blaming market entry and gamification, in other words, retail traders, for the instability in this market. You see where this is leading? Because it's a problem. The PFOF, which is payment for order flow, business model makes it happen, with further retail trading growth expected as $70 trillion in wealth transfers from baby boomers to younger generations in the next 25 years. Do I think it's going to happen again? The answer is yes, for sure, no doubt about it. How it's going to manifest itself, I'm not sure, but for sure it's going to happen again. This is a quote by the CEO of Apex Clearing Corporation, Bill Capuzzi. Guys, it is going to happen again. Why? Because they've done nothing to fix it. In fact, it's gotten 10 times worse, in my opinion. Okay? There are major flaws within this market that you need to know about because it is messed up, and it's not in our favor, guys. It's in the hedge funds and market makers who keep manipulating the system because there's no reinforcement. Let me continue. What about the future of payment for order flow? Throughout the report, there is a reoccurring theme that the payment for order flow business model was the progenitor of the meme stock market event, specifically how Robinhood approaches it. Robinhood's disproportionately high order flow and unique formula for calculating payment for order flow rebates strained several market makers and introduced risk to the stock market. Game stopped. How the meme stock market event exposed troubling business practices, inadequate risk management, and the need for legislative and regulatory reform. Robinhood's unique spread-based formula even led to conflicts with Citadel Securities. Electronic messages revealed they had discussed that payment for order flow rebate rates were unsustainable given the extreme levels of trading volume. And then they have a figure 2.5 Robinhood's Senior Management Trading Operations 1/27/2021 at 2:34 p.m. and 43 seconds. Say I know what you said about GME and AMC, but all are complaining, it's blacked out, blank is saying they haven't decided but think they want to limit payment for order flow on one or both symbols. Source: GameStop, how the meme stock market event exposed troubling business practices, inadequate risk management, and the need for legislative regulatory reform. Guys, this is, those of you listening, this is the figure that they're showing in the article that is discussing Robinhood and Citadel discussing the payment for order flow prior to this event. Now, let's continue. Furthermore, the report separates Robinhood as distinct from other brokers using the same model because Robinhood generates income by volume. It is incentivized to push every customer into making as many trades as possible. This leads to gamifying trading to increase activity and even allowing entry traders to engage in exceedingly risky margin trading. Virtue Financial, market maker, confirmed Robinhood's pivotal role as they have received more orders from Robinhood than all other clients combined in that same period. For these reasons, Alexis Goldstein, Americans for Financial Reform, Sal Arnuk, Themis Trading, and Dennis Kelleher, Better Markets, advocated for payment for order flow to be either banned or curtailed because it distorts order routing. It sure does, guys, because when you're trading on these platforms that have payment for order flow, it's basically giving the market maker, let's use Robinhood as the example since this is the one that they're discussing here. It gives Robinhood a financial incentive for them to route it to the market maker who's going to pay them the most money, whether that be Citadel or Susquehanna. But they're then in turn, Citadel and Susquehanna, allegedly, I don't want to get sued, but allegedly are getting a leg up because they're getting this massive volume, guys, which is not being traded on the NASDAQ or, you know, the lit exchange. It's being traded through dark pools because they are able to front load those trades knowing what's coming in, and they can get a leg up if they want to drive the price down. Again, allegedly, no one wants to be sued here, but can you see how this is working against the retail trader and creating unfair, unstable markets? Let me ask you to think about something as we're reading through this. Knowing the great level of dark pool trades, knowing that hedge funds are getting payment for order flow for their trades and that they're not being taken to the lit exchange. Do you think that this has any impact on why the price of GameStop, AMC, BBIG, Revlon, so many other tickers that I can mention, Adder, Redbox, do you think that This is affecting their price despite when they have periods of very high volatility and very high orders. Like, let's take a look at Redbox that's traded multiple times its float in a day, guys. Like, we're talking 10x its entire float in a day. Let's think about that. Please think about how the fact that payment for order flow and them sending orders to the dark pool versus the lit exchange is affecting the price. And then you tell me if you think there's a conflict of interest. I'd love to hear it. Comment below. Let me continue. Okay. So Robinhood reeled ahead of payment for order flow crackdown, but rallies after rating upgrade. It seems that current SEC Chair Gary Gensler agrees with that conclusion. In May's hearing, he noted that payment for order flow enables one or two wholesalers to have a dominant share in the retail market. Based on that sentiment, the SEC has already announced a regulatory crackdown on payment for order flow practices this month. In turn, Robinhood stock suffered a severe decline amplified by reputational hits in a market downturn, triggered by the Fed's interest rate hikes, which could trigger a recession. Guys, we are definitely already in a recession, and if this continues, mark my words, we will be in a depression because things are not looking good here. But there's a chart that shows, how Robinhood's price, since its all-time high prices last August of $70.39, Hood has dropped down by negative 88%. Guys, all the way down to $8.39 at the time of this article, and it's somewhere around $8 currently, I believe. It's basically taken a beating, and it's lost a lot of its customers because nobody in retail should be trading on payment for order flow platforms, guys, because they're using it against us. So if we're continuing to have trades on these payment for order flow platforms, then I guess we deserve some of what's happened. Not that it's right. I'm not saying that, but I'm saying we all need to wisen up and get our money out of these platforms because they're using it against us for their monetary gain. They are not acting in the best interest of their customers, which is retail traders. Okay. Nonetheless, during the last week, Hood went up by 16.84%, suggesting there is plenty of retail interest left as many are taking advantage of discounted assets. Additionally, Hood's rally comes after Goldman Sachs upgraded the stock's rating from sell to neutral. In the end, with or without payment for order flow, Robinhood can look forward to a new era of stock trading as generational wealth transfer takes place and retail investors get more capital over time. Guys, I'm going to add a little side note. In my opinion, the reason why Robinhood had a little bump in its price was because there was a rumor started that Sam from FTX is considering buying out Robinhood. So I believe that that's why we saw the little bump in their ticker price, which has since declined as the rumor was basically taken away. So anyways, that was the end of this article. Let me get into the quote that it mentioned in there because I want to show you it in the report because it's very interesting. Okay, for those of you listening and not watching, this can be found on page 7 of the GameStop report. And I apologize because I had that covering it. But it says, in quotes in big blue bullet out area, guys. And so, if the question is, do I think it's going to happen again? The answer is yes, for sure. No doubt about it. How's it going to manifest itself? I'm not sure, but for sure it's going to happen again. Again, guys, this is from Bill Capuzzi, who's the CEO of Apex Clearing Corporation. It's going to happen again, guys, because the problem has not been fixed. They've done nothing to make it any better. And like I said, guys, it's far, far worse. And it continues to get worse because there's no enforcement. Now, let's get into that. I'm going to show you guys, True Demon's video where you can be found real quick on YouTube. And then I'm going to get into my summary of it. Okay, guys, this is Hell's Trading Floor, the Devil's Stockbroker. This is where you can find True Demon, and his title of this video is the Meme Stock Report Deep DD and Analysis. Let's get into my summary, which I will leave that up for you. All right, guys. So let me start by saying that retail should all be given the same information as Wall Street has, so we can make better educated trading decisions. Currently, retail is at a disadvantage, guys, because we do not have the same tools that the elite have, which is not fair. We all should be on the same page and be able to make the same educated decision. As I go into this report, you're going to see for yourselves that the way they think about retail traders is that we're uneducated. Kind of, it goes back to that stupid video that Gary Gensler put out and the SEC put out regarding retail traders and the pie in the face. Like, truly, guys, it's sad, but this is how they think of us. It absolutely disgusts me, but it is what it is. So, January 28th, there was inadequate capital, inadequate liquidity, and the requirements between brokerages were just not being taken care of, guys. They basically were in a $9.7 billion market call. Robinhood alone, never mind what else was happening. And as you're going to see in this report, as much as I dislike Robinhood, I believe that they used Robinhood as the scapegoat in all of this, and that they needed to dig much deeper into Citadel, Virtue, Susquehanna, some of the huge market makers out there that are also benefiting from this situation, you know, with the payment for order flow, because guys, there is a massive problem. So let's get into the findings, because I feel that that's most important. Robinhood's culture prioritized growth above stability, exhibiting troubling business practices and not enough risk management. During the meme market event, Robinhood's payment for order flow formula became a point of contention between Citadel and Robinhood. Robinhood's payment for order flow and unique formula for calculating payment for order flow rebates strained several market makers and caused risk to the stock market. Robinhood testified the company was always comfortable with its liquidity. Yeah, they may have been always comfortable with it, guys, but clearly it was a problem if they were in a $9.7 billion margin call. They were comfortable, but they didn't care about the rest of the market. So where did their comfortability come from? Clearly it wasn't evidenced by the actions leading up to the buy button being taken away. Guys, what I mean by that is, if they were so comfortable with their liquidity, then why would they have to take the buy button away? Clearly, they weren't comfortable with their liquidity, or that would have never happened. Robinhood did not incorporate FINRA's best practice observation, as it relied on incomplete statistical models to calculate its collateral obligations, and it did not utilize guidance from the DTCC for calculating collateral obligations. Notice I say guidance from the DTCC, because they'll guide them, guys, but as I get further into this, you'll understand that despite their guidance, there's really no penalization, so why would they? On January 28th, before market open, Robinhood Chief Legal Officer notified the DTCC it could not meet its collateral obligations. And that was the $9.7 billion that they couldn't meet, guys. They were in a margin call. They couldn't meet it. And they received a waiver from the DTCC that prevented them from defaulting on its regulatory collateral obligations. The DTC basically said, no worries, you can't meet the margin call. Don't worry about it. Guys, $9.7 billion. They basically just washed it away like it was nothing. No problem, you can't meet it. This put the entire stock market at risk, guys. This could have created the collapse. Seriously could have created. I want you to realize that as I go on, because it's really messed up. All right. So to me, that sounds like a hall pass that protected Robinhood and basically screwed over all of retail, guys. They basically said to them, no problem. Meanwhile, they took away the buy button, and retail got screwed out of that squeeze that, you know, great, it went to $500, but imagine where it would have been if the buy button wasn't taken away. The most extensive trading restrictions were by brokers and dealers facing the greatest operating and liquidity concern, guys. Perhaps the most alarming and troubling finding, most of the firms the committee spoke to have no plans to change their policies on how they will meet collateral requirements during extreme market volatility or to adapt trading restrictions when market volatility warrant. Guys, they have no plans to change this. And the SEC and DTCC aren't doing a single thing about it. Do you see the problem here? Let me go on. The DTCC waived $9.7 billion of collateral deposits, otherwise known as margin calls, on January 28th. The DTCC has no written policies and procedure for waiver or modification of a distinctive, quote unquote, charge for undercapitalized brokers. So basically, there's no policies put in place, guys, of what they're to do in regards to create, like, why they would create a waiver or a modification. They can just decide to do one if they want to. Apparently, I don't think there's been an issue where they haven't done one, because I think we'd see a lot of coverage being taken place, but they're not doing anything, and there's no rules in place. During periods of acute volatility in the 2 years prior to the meme stock market event, the DTCC regularly waived such charges during periods of acute volatility. Why do they get a hall pass and we don't? Guys, I kid you not, if you had a $10 margin call and you refused to pay it, there's a good chance that you would get a liquidation and a $35 fee, or depending on your brokerage, whatever fee they apply. But in general, I believe most of them charge between $25 and $35. Who knows? It could even be more with inflation. And they'll liquidate whatever security they decide they want to liquidate or probably need shares of in order to meet your margin call. But yet they can be millions of dollars in margin and there's no penalty. Think about that. The broader implications. The meme stock market event revealed how rapid growth and innovation in retail trading presents novel issues for market stability and orderliness. The industry and regulators have neither anticipated or addressed, guys. So basically, this showed them that there's problems with market stability and there's nothing in place to address it or to do anything about it. Retail investors accounted for 20% of stock market activity in the first half of 2021 and up to 25% on peak trading volume, days up from 10% over the prior years. So days, 25% on peak days, guys, leading up to these events, and 20% together, all in all, in the first half of 2021, compared to previously it only being 10% in the prior year. That's insane. That just goes to show you how much retail traders are coming into this market, guys, and that they're going to have to make plans because they didn't anticipate this. This is the first time that retail investors accounted for a significant portion of this activity. Retail trading accounts have been rising sharply on platforms such as Robinhood and Apex Clearing Corporation. These statements should send red flags to all retail investors, as it seems they're blaming retail for this volatility, guys. Everything I just said to you in here was what was in the report, just so you know. So basically, the way that I see it when I read it is that they're blaming increased market volatility on the fact that retail is trading now, which is BS, guys. I mean, I'm sure we add to the volatility, but we're not to be blamed. Crazy. New investors under 45, 1/3 So 1/3 of new investors under 45 held an account balance under $500. Retail traders were trying to better themselves in their financial situation by investing in the stock market and were stolen from in this event. This makes me sick, guys. So the reason I'm adding this in here is because I just want to show you that 1/3 of all retail accounts that were involved in the GameStop and AMC and other meme stock frenzy held account balances. They were under 45 years old and they held an account balance under $500, guys. These rich, greedy MFs on Wall Street are stealing from people that don't even have $1,000 balances. How messed up is that? I mean, seriously makes me sick. Now, just so you know, Apex is the clearinghouse for Robinhood, Webull Interactive Brokers, and other trading apps that are payment for order flow. Just so you know, retail trading carries risk. And guys, we need to look at this too. In the report, they are heavily focused on gamification, making it easier for retail traders to access the market and to invest. Gamification is not the problem. Lack of retail education is the problem, guys, and they're trying to prevent retail from becoming informed investors. Like I said back in the beginning, the biggest problem is that we do not have the same tools that Wall Street has. So we are not able to make the same educated decisions as they are. Why is there a complete lack of clarity for retail? Why are we not given the same rights that hedge funds are given and the same information, guys? This is a problem. But you know what? There's a lot of smart retail out there, and there's a lot of us that do a lot of DD every day, and that we are finding these problems. If we're able to find them, why can't the SEC? I'd like to know. There are now millions of investors involved in the markets. I feel that this is creating an extreme fear of a true transfer of wealth, guys. They are afraid that retail is going to get the leg up and start learning the tricks of the trade and being able to overcome them. And if we become the ones in power, that's going to create extensive fear to them because they're so greedy, guys. They don't want to share their wealth. They're afraid we're going to take it over completely. I think that's because they realize how smart a lot of us really are. And the more educated the public becomes, the higher the odds are of us filling the wealth gap. God forbid. Seriously. Like, that's what's in their minds. I'm sure of it. Knowledge is power, and retail needs to focus on educating themselves and improving our trading, guys. I can't stress that enough. You know, the more we know, the better traders we become. And focus. We all need to focus on educating ourselves and becoming better each and every day, and not just educating ourselves to the terms and everything, but educating ourselves to the corruption that's going on in our market and figuring out a plan, guys, how we can trade it and stop it. It deeply saddens me that this report is summing up the gamification of trading as retail traders that are gambling addicts. And guys, I know that, True Demon definitely talked about this, and it's so true. We're not in this market as a gambler. We're here to make educated choices and investments, to take control of our own investments and to try to better ourselves. What is wrong with them? And in this report, focusing so much on us being gambling retail traders that are just, trying to get our next fix or something. It's really crazy. All right. Here's another quote that's a major concern. And so the question is, this is the one that I went over before. Do I think it will happen again? Answer is yes, for sure. No doubt about it. How is it going to manifest itself? I am not sure, but for sure it's going to happen again. Guys, this is because retail investor trends like stocks. Hold on. I can't even read my own writing. I apologize. Retail investor trends like stocks gaining popularity on social media increasingly affect the price and trading volume of securities. This has implications for market activity, trading, infrastructure, and regulation. Regulators must ensure that broker-dealers properly assess and prepare for the new implications of such new innovations. The meme stock event demonstrated the need for modernization of our retail market regulatory structure in ways it anticipates, detects, and corrects for capital liquidity and operational risk associated with the rapid growth of retail trading, and the technological and business model facilitating such growth. Retail superbrokers need modernization of key aspects of the self-regulatory framework. Superbrokers are self-directed broker-dealers. Any firm that does all business through FINRA needs a modernized liquidity rule to adequately respond to current market dynamics. Guys, so these super brokers that are self-directed broker-dealers, they're talking about like Robinhood and Citadel. Like they're a broker-dealer relationship. And they're doing their business through payment for order flow. And there needs to be regulation to this because currently there's not. And as I go on, you're going to see what I'm saying. The NSCC, which is a subsidiary of the DTCC that sets and enforces rules for clearing equities, engaged in an insufficient monitoring of its membership and regularly waived certain clearing fund obligations. Guys, this is like that $9.7 billion that they waived. Well, they've been doing this in the past. Every time it got high, they just call them in and they basically would waive it. These regulatory shortcomings may have contributed to the lack of preparedness certain broker-dealers exhibited in their ability to navigate the capital and liquidity challenges of the meme stock events. FINRA previously issued guidance, but it's non-binding and does not require systemic liquidity reviews of its broker-dealers. FINRA has risk monitoring policies to assess broker-dealers' liquidity and capitalization issues. However, FINRA's routine cycle examinations review capital and liquidity on a case-by-case basis for individual broker-dealers are not mandatory. Guys, what I'm saying here is that the risk monitoring that FINRA puts into place regarding the liquidity and capitalization is a problem because FINRA's routine cycle examinations, which they have in place to review the capital and liquidity, are done on a case-by-case basis for individual brokers, and they're not mandatory. How is it that they don't have a mandatory role in place to review that they have enough capital and liquidity to meet the market? Basically, that's like saying that it's up to them, to be sure that they're monitoring themselves. This is not well, clearly it is a self-monitoring environment that they're in, but how is that even right? This is a massive problem. Neither FINRA or the SEC have a standalone liquidity rule, guys. FINRA can only require compliance with the SEC filing rule during cycle examinations, which many industry experts consider outdated. Without an updated liquidity rule from the SEC, FINRA lacks an adequate foundation to police the liquidity of its members' firms. The NSCC maintains a watch list and an enhanced surveillance list, but needs a modernized plan to oversee its members' firms. Guys, the best part is that they have a watch list, right? And an enhanced surveillance list, but they don't notify the brokers that they're on it. And they don't even really do anything once they're on it. They can make suggestions, but they don't enforce them. Currently, FINRA can make suggestions, but has no way to enforce them. Seriously, guys, WTF? The broker could choose to ignore the advice without consequences is what this is saying. They don't have to do anything. That's like telling your child they need to be in bed at 9 p.m., but ignoring the fact they're still up, sitting on the couch watching TV in the living room at 10 p.m. I mean, rules that aren't enforced have no consequences. It's messed up. And we're not talking about a child watching TV, guys. We're talking about things that affect billions of dollars in our market every day. This is downright scary. The NSCC has regularly waived certain clearing firms' requirements. Excess capital premium charges were regularly waived or reduced. The repeated failure of excess capital premium charges from deterring firms from accumulating risk is concerning. You think? That's the understatement of the year, guys. It's far more than concerning. It's a red flag, in my opinion. The NSCC rules permit discretion in waiving or reducing excess capital premium charges. Guys, why do they not have a set of rules that say what the requirements are and what percentage they need to have before, it's a red flag, before it's a warning? And when it gets to that level, why is there nothing in place to enforce making them have the requirements? The way I see this, guy, is they can just keep doing whatever they're doing without any consequences whatsoever. The rules contain limited guidance detailing how or when it's appropriate to waive or modify such changes. This lack of guidance undermines the predictability of NSCC decision-making. This is allowing firms a quote-unquote hall pass, creating very high risk in our markets. Guys, this is nuts, because it appears that no one is holding these brokers or the market makers accountable. This can cause massive problems for all firms. This can basically cause the entire stock market to blow up, guys, and go under, because they don't have the money and the regulatory practices and procedures in place in order to mandate this. What the heck is going on? So, this makes me wonder, are all firms corrupt? If some aren't, why aren't they saying this needs to end? Because they're putting everyone at risk, not just their own firm, guys. Every single brokerage firm out there is at risk. And this is an absolute ticking time bomb that's just waiting to be set off. The meme stock market event exposed weakness in capital and liquidity planning and in the robustness of the technological platforms of financial service institutions upon which the orderly functioning of the stock market relies. Firms don't understand how the NSCC's excess capital premium charges are assessed. They don't understand how the NSCC's excess capital premium charges are assessed because there's no rules or regulatory guidance put into place to explain it to them. Guys, there needs to be set rules, and the fact that there's not is just very eye-opening. There are no industry best practices on how firms can ensure they have enough capital and liquidity to meet NSCC margin requirements. More concerning, certain broker-dealers remain thinly capitalized and consciously risk attracting these charges on a regular basis. Given the NSCC often waives these charges, the firms feel it's unlikely they'll be seriously penalized for their risky behavior. Guys, it's kind of like a child who, again, you tell not to do something, but as many times as you say don't do something, there's no punishment if they do. What's that child going to do? Of course, they're going to keep on doing it, right? We've all seen kids that are out of control and don't listen to their parents, and parents that just let them do whatever they want. Well, this is kind of how I feel that the stock market is. There's no punishment for them, so why should they do anything to change? Guys, think about it. All right. The investigation committee found evidence multiple broker-dealers, third-party clearing operations, market makers, public stock exchanges, and others suffering technology outages during the meme stock event. Guys, they claimed that there were technology outages and that's why our trades couldn't go through. These outages are particularly concerning among market makers that are lightly regulated and play a significant role in executing retail trades, like Citadel, like Susquehanna for BBIG. There is no FINRA or SEC requirement requiring that broker-dealers be active members of a public exchange. So if they're not an active member of a public exchange, then that means all their trading is being sent to the dark pool, guys. It's not being traded on a lit exchange, or it's going to a third party like Robinhood sending their orders to Citadel for execution. And where do you think Citadel is sending them? That's right, guys, to the dark pool, allegedly, according to facts that I see every day for dark pool trades. Put this all together. It's a problem. Now let's go back to January 28, 2021. Robinhood was not connected to the New York Stock Exchange, NASDAQ, or any other public exchange where it could have routed customers' trades for execution, guys. They weren't sending any trades to the lit exchange. Instead, it was solely reliant upon its market maker firms to execute trades because they're getting payment for order flow for every trade they send there. If Citadel and Virtue, who were under significant operational stress that day due to the historic volume and volatility, not been able to accept Robinhood's payment for order flow, then trades wouldn't have been executed at all, guys. That means not only would you have had the buy button taken away, but you wouldn't have been able to sell either. This is a problem, and this should be a red flag to you. And again, if you're still using Robinhood, I want you to ask yourself after reading this, do you think it's time to make a change? And only you can decide that. Trust me, I fall in the same pattern, especially when it comes to using Robinhood for options. It's so convenient, guys, but this is a disaster that's going to blow up. And what happens next time? What happens next time if the market makers that they send their payment for order flow to, i.e. Citadel, Virtue, Susquehanna, etc., are not available to take those orders because they don't have the liquidity? What's going to happen to your money then? You've been in these trades for a year, some of you 2 years or more. Are you going to risk staying in a payment for order flow type situation and risk not being able to execute your trades when you want to sell them or to buy more? Think about it. All right, this is the committee's recommendations. 1. Understanding the influx of retail traders. Congress should adopt legislation mandatory key regulators, including the SEC and FINRA, should study how existing market rules and supervision will need to evolve to address new technological developments, including the possibility of social media-driven market activity. Guys, this is a problem because they're trying, what I'm seeing here by this statement is that they could potentially blame the activity on social media and try to penalize people for discussing the market on social media, even though, nobody's telling anyone to buy, sell, or do anything different. They could still penalize them. This makes no sense to me because this is how we work as a community to gain education because we're not given the same tools as everybody else. And now they want to blame social media. I sense a big issue with this, so just keep it in the back of your head. The SEC should consider ways to implement trading halts to respond to concentrated volatility in a limited number of stocks. Really? Guys, I see a big problem with this statement too. Trading halts to respond to concentrated volatility? What? So they're going to halt it when it's appropriate or they're losing? That should be a red flag to all of you. That's a little bit concerning. Supervision of retail facing super brokers. Congress should adopt legislation requiring broker-dealers establish and maintain a connection to a public market. Guys, 100%. They need to be connected to a public market. The fact that Robinhood that day, and I don't know if this is like every single day, that they're not directly attached to the New York Stock Exchange or the NASDAQ or any public market, and that all their orders are going through their market maker for payment for order flow is seriously messed up. All right. Congress should adopt legislation requiring broker-dealers that make markets and provide liquidity to other broker-dealers which process above a predetermined threshold of order flow be subject to Regulation SC1. SEC and FINRA should enhance large retail-facing broker-dealer examinations and mandate stress tests that focus on liquidity management to account for the prospect of social media driven market volatility. Guys, again, notice they're focusing on social media and retail traders here. I don't know. SEC and FINRA should require clearing brokers to establish written plans to address extreme market volatility and fully disclose both the contingency plans and any trading restrictions to the market in real time. Yep, I agree with that. They absolutely should have clear plans to discuss the market volatility and a set of rules, guys, and restrictions. And they need to implement them. Implement them and enforce them. Congress should adopt legislation that directs FINRA to conduct more thorough supervision of the broker-dealer industry, and the SEC should conduct more thorough oversight of FINRA's activities and any corrective actions FINRA may propose. 100%. When individual firms introduce trading restrictions, they should be required to notify the SEC and FINRA. FINRA should engage in enhanced monitoring to ensure trading restrictions are appropriate, tailored, and not in place longer than necessary. This makes me wonder, guys, what's coming, because absolutely trading restrictions they should have to notify the SEC before they even consider introducing a trading restriction. But guys, is that fair to retail? I don't think so. Why should they be given hall passes? It's wrong. Anyways, number 3, strengthen capital and liquidity requirements and oversight. The SEC should introduce capitalization requirements for clearing brokers. The SEC should introduce a clearing rule for brokers. FINRA should establish a rule-based framework governing liquidity planning for clearing brokers. Guys, 100% on all of those. DTCC and NSCC should review how it conducts surveillance of members that pose a greater risk. You think? Absolutely. FINRA should focus systematically on assessing the sufficiency of clearing brokers' liquidity planning. Yeah, absolutely. DTCC and NSCC should introduce clear written policies and procedures and establish transparency under which the DTCC may waive excess capital premium charges. Guys, they should definitely have a policy and procedure in place and shouldn't just be allowed to waive excess capital requirements because they feel they should be able to give a hall pass to dealers to get them out of trouble. This is wrong. Such decisions should be subject to review by the SEC. I believe such decisions should be mandatorily reviewed by the SEC. The DTCC and NSCC and the SEC and Congress should introduce an emergency backstop funding facility for NSCC member firms that provide emergency liquidity to the NSCC. False. Guys, absolutely not in my opinion, because the reason they're doing this, let's put it this way. The brokers and market makers, they find a way to abuse everything. So if they give them an emergency funding situation, that's basically giving them another hall pass. How often will it be an emergency they're reviewing? If they add liquidity for these bad acting firms, they'll abuse it. Absolutely. And they'll rely on this as a bailout, allowing these bad actors to continue to screw up. 100%. This is messed up. Congress knows retail is a threat to the system, guys, because they acknowledge we're not leaving. Retail needs to continue putting pressure on Congress to make changes and to create a free and fair market for all. We need to elect members of Congress that will act in retail's best interest and not take political bribes. We need to start voting out members of Congress that did not act in retail's best interest, guys. We are in a very, very bad situation. And if we as retail do not come together as a community and demand change, guys, then nothing is going to change. You can see from the part of the report that we've reviewed so far that there's a big problem. And not only are they making Robinhood the scapegoat, but in my opinion, they are blaming retail on the problem. Guys, this problem has been going on in the market for decades. And I'm going to go so far as to say it's probably been going on for not long after the stock market came into existence. Because unfortunately, there are bad actors in the system, and there have been for a very long time. I believe that we need to make a lot of changes. I believe that we need to increase awareness, which is why I took time out of my 4th of July to make this video for you, which I've been meaning to do for a while. But it's a priority because all retail needs to be aware of what's happening and that these changes need to be put into play. Please think about that today, because today is a day where we celebrate freedom of our country. And we need to collaborate as retail traders to create a free and fair marketplace for all. That is my wish this year for our 4th of July. I want to wish all of you a safe, happy, and healthy 4th of July. And please enjoy time with your family and friends today. I hope you all have a wonderful holiday, and I hope you'll all consider what it is that's been addressed in this report. And please, when you have time, it's a very interesting and eye-opening read, guys. I highly recommend all of you go through it and take it piece by piece. You know, there's a lot to go through and a lot to break down. This is only basically the summary that I've gone through, because I'd be talking for hours. But have a wonderful day, and I hope this has opened your eyes to what I keep saying when I say that this is a corrupt market. It is certainly not free and fair for all, guys. All right. Thank you. If you didn't already, please like and subscribe. I appreciate each and every one of you. Happy 4th.